Warren Buffett is considered by many the greatest investor of all time. If you placed $1,000 into his investment company when it started, you'd be $30 million richer today. These types of returns might not seem realistic, but how did Buffett actually do it? The answer lies in the fact that Warren Buffett understands what many people don't, and he's sticking to a few important principles that you could use in your own life. Welcome to Bulls and Bears. If you're new to the channel, hit the like button and subscribe if you enjoy our content. Now let's go back to the video. In a seminar that Warren Buffett hosted, he said that most people look for three things when they hire people. He said that in most cases, we look for intelligence, initiative or energy, and integrity. As for investors, Warren Buffett said that they behave in human ways. They get excited during bull markets, and some look in their rearview mirror and think, I made money last year. I'm gonna make more money this year. He mentioned in the seminar that investors are always looking in their rearview mirror, and when they see that they've made a lot of money, they'll just keep on pushing the prices. However, if no money was made, they'll just say that the place is lousy and just wouldn't care about the underlying business. However, investing in things that have no money in it could be a huge opportunity. Warren Buffett then stated that one of his mentors was Ben Graham. He was taught to buy things based on quantity. This means looking around for cheap things. He then said that he went around looking for what Warren calls cigar butts of stocks. The cigar butt approach to purchasing stock is like when you're walking down the road and you're searching for cigarette butts. You then find this terrible looking, soggy, and ugly cigar with one puff left in it, but you get it and puff the last one. It's disgusting and you throw it away. However, it was cheap. You then try to find another soggy, one-puff cigarette. Warren Buffett then admitted that this is what he did for years. He then admitted that it was a mistake, because even though you can make money doing it, he stated that you can't make it with big money. It's so much easier just to buy wonderful businesses. Presently, Warren would prefer to buy incredible organizations at fair prices, as opposed to fair organizations at incredible prices. He then continued the seminar by saying that he has an old-fashioned belief that he can only expect to make money in things that he understands. What he means by that is not about what the product does, but rather what the economics of the business would look like in 10 to 20 years. He then uses Wrigley's chewing gum as an example. He mentioned that the internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there years from now. Warren Buffett then states that evaluating a company based on what they do and its economics is what he calls his circle of competence. Your circle of competence is based on your understanding of the competitive aspects of a particular business. However, Warren Buffett is not perfect. He has also made mistakes as an investor. In the seminar, he admitted that his biggest mistake was the mistake of emission and commission. He openly admitted that he lost at least $5 billion by, quote, sucking my thumb. Warren then told a story that about 20 years ago, Fannie Mae was having some financial troubles, and he could have bought the whole company almost completely for free. He then mentioned he did know enough about Fannie Mae, and he blew it, and that this transaction never shows up under conventional accounting. However, Warren then admits that he knew the costs of it, that passing up on Fannie Mae was a big, big mistake, and that emission is way bigger than the commission. He then emphasized that big opportunities in life need to be seized. As would be natural for him, he said, we don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even do it in a small scale is just as big a mistake almost as not doing it at all. You gotta grab them when they come, because you're not gonna get 500 great opportunities. At the seminar, Warren Buffett mentioned that he's not going to sell wholly owned businesses no matter the offer. He said that even if somebody offers them 3 times what the business is worth, they still won't sell it. He said that he could be wrong in this approach, but he also stated that he's not wrong if he owned 100% of Berkshire, because that is how he wants to live his life. He mentioned that selling off wholly owned businesses is like selling one of his children just because someone waved a big check. He then said, "So I won't do that, and I want to tell my partners I won't do it so that they're not disappointed in me more and more." Warren continued that with specific types of stock, they implement this particular type of approach. Although, he also stated that they might have a different approach if they were short on funds, and there are a lot of opportunities that are coming to them. However, their inclination is not to sell things unless they get disappointed with management or the economic characteristics of the business change in a huge way. And then, a person from the seminar asked Warren about how to find the intrinsic value in a company. He then replied with the following statement: "Intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is." He then explained that the only reason for investing is to get more money at a later date. He then uses the United States government bond as an example. He explained that with the US government bond, it's easy to tell what you're going to get back because it states it right on the bond. The bond shows you when you would get your interest payments and when you would receive your principal. He also mentioned that the bond might change tomorrow, depending on the change in the interest rates. Warren then continued to explain that cash flows are printed on the bond, but they are not printed on a stock certificate, and that was the job of an analyst. He said that the job of an analyst is to print out, change that stock certificate into a bond, and then mention that this is what I think is going to pay out in the future. He then uses CocaCola as an example. Warren stated, if you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? He then mentioned that the main question is how much money the business is going to give you. He reiterated that it is not a question of how many analysts would recommend it, or the volume of stock, or what the chart looks like, but it is a question of how much money it's going to give you. He said that it's true if you're purchasing an apartment house, a farm, oil in the ground, or any financial asset, you're investing now to get more money sometime in the future. Some of the important questions that Warren Buffett mentioned that you need to consider are how much money you're going to get, when are you going to get the cash, and how sure are you? He states that when he purchases a business, whether all of the business or just a small part of it, he always thinks that he purchases the whole business, because that's his approach to investing. He thinks about what will come out of the business, as well as when, and ideally, you would want them to use the money they gain and receive higher returns on it as you go along. Warren Buffett then states that Berkshire has not distributed a single thing to their shareholders, but their capability to distribute increases as the value of the business they own increases. He then poses a question about what Berkshire could distribute from $100 billion if it was sold today. He then answered by saying, if you're going to buy the whole company for $105 billion now, we can distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now. And that's what it gets down to. And if you can't answer that question, you can't buy the stock. So what did you think of Warren Buffett's approach to investing? How can you apply these tips to your own way of thinking when it comes to investing? Let me know in the comments below. If you enjoyed this video, hit that subscribe button, click on the notification bell to be updated on our new videos, and don't forget to give us a like if you want more videos similar to this one. See you in our next video!